Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, before we even get into the sheer scale of what we're unpacking today.
It is massive, by the way.
Right, it's huge. But having the right tools to actually visualize these market moves is just crucial. If you want a little help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Highly recommend it.
Yeah, it's a TradingView indicator suite. Basically, it displays visual buy and sell chart alerts, trend direction tools, support and resistance zones, and areas for take profit and stop loss planning.
And it works across the board, right?
Yeah, exactly. Built for multiple markets, so stocks, forex, crypto, gold, indices, you name it. But, and this is important, just remember VIP Algos is an educational chart analysis tool only. It is not financial advice. It doesn't place trades for you, and it certainly does not guarantee profits. Trading always involves risk, so, manage yours carefully and do your own research. That is an affiliate link in the description, so we may earn a commission if you use it at no extra cost to you.
Perfect. So let's get right into it.
All right, let's do it. So imagine for a second that there's a modern-day gold rush happening right in front of us. Everyone's trying to figure out who's going to find the biggest nugget, right? Which software company is going to create the ultimate artificial intelligence model?
The shiny stuff.
Exactly. But what if the real winner isn't the one panning for gold? What if the real winner is the one selling the pickaxes, pouring the concrete, and laying down the heavy copper wire?
I love that analogy, yeah.
Because that is exactly the setup we're looking at today. CoreWeave is having an absolute breakout moment. I mean, they jumped 3.85% today, hitting $82.64.
It's a huge move.
It is. And what's fascinating to me is the divergence here. The legacy cloud players, companies like Cloudflare and Snowflake, they're kind of stalling out. Yet this specialized infrastructure player is just accelerating right past them, picking up a fresh buy upgrade from Truist along the way.
Yeah, it's a profound shift in institutional attention, really. I mean, the market is finally waking up to the physical reality of artificial intelligence.
The physical reality.
Yeah, exactly. For the longest time, investors treated AI like a purely digital phenomenon, like it was just, magical code living out in the ether.
Right, just somewhere.
But AI is incredibly physical. It requires massive, hyper-specialized warehouses packed with servers that run so hot they would literally melt standard data center racks.
Oh, wow. Literally melt them.
Literally. Standard cooling can't handle it. So when you see a stock like this break away from the broader software pack, it tells you that the smart money is trying to capture that foundational infrastructure layer. They want the company that actually owns the hardware processing all of this data.
Okay, so that brings us right to the wealth building context for anyone looking at their portfolio right now. How does a company like this fit into a long-term strategy?
Well, you really have to follow the money trail.
Right. And speaking of the money trail, we have this staggering data point. OpenAI recently announced a target to spend $750 billion on compute alone by the year 2030.
It's just wild.
That's an increase of $150 billion from their previous estimates. I mean, $750 billion. That is roughly the GDP of Switzerland, dedicated entirely to computer processing power.
It's a number that almost breaks your brain when you try to model it out.
Yeah.
And you have to realize for your own strategy, that mountain of capital doesn't just evaporate. It flows directly down the supply chain.
Right. It has to go somewhere.
Exactly. Yes, a massive chunk goes to companies designing the microchips. But those chips are utterly useless if you don't have the high-performance, specialized cloud infrastructure to rack them, cool them, and network them together so they can actually train these massive language models.
And that's where CoreWeave comes in.
That is the exact niche they occupy. For an investor, adding this to a portfolio is essentially buying a toll road. You don't have to guess which specific artificial intelligence application is going to win the consumer market.
You just own the pavement.
Exactly. You just own the pavement that every single byte of data has to travel across.
I mean, I love the toll road analogy. I really do.
Yeah.
But I have to play the skeptic here, especially for the listener trying to protect their capital.
Sure, let's hear it.
When we see a target like $750 billion, that looks incredibly like a classic, somewhat desperate land grab phase. Tech giants are throwing infinite amounts of cash at infrastructure because the absolute worst-case scenario for them is being left behind.
Right, the FOMO is real.
Exactly. But is this a sustainable foundation for long-term wealth generation? Or are we looking at a speculative bubble where if these AI tools don't start generating massive profits for the actual end users, that spending faucet just gets violently shut off?
That is the multi-billion-dollar question right there. And it's exactly why you have to understand the profile of this stock before you even think about touching it.
Okay,
This is a hyper-growth, hyper-capital-intensive play. It is absolutely not a safe, defensive dividend stock that you buy and just forget about.
definitely not.
No. This is tailored for an investor who is completely comfortable taking on high risk in exchange for exposure to what could be a historic secular spending cycle. You're betting that the demand for compute power is a fundamental paradigm shift, not just a temporary corporate panic.
So if we're betting on that paradigm shift, let's look under the hood at the fundamentals. Let's see if the math actually works, because this is where the story gets wildly complex.
It really does.
On one hand, we have management guiding for a jaw-dropping 108% year-over-year revenue growth for the second quarter.
Which is astronomical.
Yeah, they are quite literally doubling the size of their top-line revenue in 12 months.
Which proves that the demand they're seeing is practically insatiable. When you can double your revenue at this scale, it means every single server rack you plug in is immediately leased out to a desperate client.
Right, the top line is a rocket ship,
Yeah.
but the bottom line is flashing bright red.
Yeah, it is.
They are currently wildly unprofitable. We're looking at earnings per share sitting at negative $3.26.
Ouch.
Yeah, and the net margin is a deeply negative 25.57%. They are burning through cash at an astonishing rate to achieve that growth. As an investor, it's hard to reconcile a company doubling its sales while, losing a quarter for every dollar it brings in.
I get that. And this is where you have to separate the cost of running the company from the cost of delivering the product.
Okay, unpack that a bit.
To understand if the core business is actually viable, you have to look at their gross margin, which is sitting at a very robust 69.38%.
Walk us through the mechanics of that. Why does that specific gap between a negative net margin and a near 70% gross margin matter so much to the long-term thesis?
Think of it like operating a highly exclusive airline. The gross margin tells us that every time a flight takes off, meaning every time they lease out a cluster of high-performance computing, it is incredibly profitable.
Okay, I'm following.
The direct cost of the electricity and the depreciation of those specific chips is vastly lower than the premium rent they're charging clients. The core transaction works beautifully.
So why a massive negative net margin?
Because they're simultaneously trying to build 50 new airports all at once.
Oh, wow.
Right. They are hiring thousands of engineers, buying land, laying fiber optics, and building out the massive corporate infrastructure to support future growth.
That makes sense.
Once that physical footprint is built and those fixed costs finally flatten out, that 69% gross margin will start flowing directly to the bottom line. It's a textbook extreme reinvestment phase.
And extreme reinvestment is almost putting it too lightly when you look at how they are actually funding this physical footprint.
Seriously.
It relies almost entirely on taking on staggering amounts of debt. Let's talk about the Helios project for a second.
Yeah, the Texas facility.
Right. We just saw a massive data point come through. Galaxy Digital is preparing to raise $3.5 billion through a private debt offering.
A huge sum.
That capital is earmarked specifically to fund CoreWeave's new critical IT campus in West Texas. Now, this facility is 260 megawatts. Just to put that into perspective for you, 1 megawatt can power hundreds of homes.
That's massive.
260 megawatts is essentially the power consumption of a medium-sized city, all being funneled into one campus just to run and cool these machines.
It's a masterclass in scale, truly. And the crazy part, the entire facility is already fully leased back to CoreWeave.
But look at the financial structure here.
Yep.
They're essentially building these massive city-sized luxury hotels using high-yield junk bonds.
Yeah, that's the reality of it.
Taking on $3.5 billion in debt works beautifully as long as the high-paying tourists, the AI developers, are booking out every single room at premium rates.
Exactly.
But what happens if the tourists decide they don't need to visit as often? You still owe the interest on $3.5 billion. The leverage is terrifying.
The leverage is absolutely the primary vulnerability. I won't argue that. But there is a structural reason they're taking this massive risk. It's all about building an insurmountable competitive moat.
Moat against who?
Our big guys.
Yes. You have to realize that the traditional hyperscalers, the legacy giants like AWS and Azure, they cannot pivot fast enough.
Really, with all their resources.
Even with all their resources, their existing data centers were built for traditional cloud storage and basic computing. They were never designed to handle the extreme power density and liquid cooling requirements of modern AI chips.
So retrofitting is a nightmare. Exactly. CoreWeave has the specialized operational expertise to deploy these high-density solutions right now. And if you want proof that this aggressive, debt-fueled strategy is justified, just look at the recent commentary from Alphabet's chief financial officer.
What did they say?
They outright confirmed that demand for AI infrastructure is still drastically outpacing their capacity to build it.
Wow.
Right? When one of the most resource-rich tech giants on the planet admits they cannot build fast enough, it completely validates CoreWeave stepping in to fill that void, even if they have to leverage themselves to the hilt to do it.
Okay, so if they are in this massive race to build capacity, that leads us directly into the Catalyst timeline.
Let's get into it.
What are the actual events coming up that are going to move this stock?
Yeah.
Because as a listener, knowing the story is one thing, but knowing when the market will react is how you actually position yourself.
Well, the most imminent hurdle is their second quarter earnings report. And management has created a really fascinating high-wire act for themselves here.
By setting that massive growth target.
Exactly. By setting the bar at that 108% year-over-year revenue growth.
Which brings up a dangerous dynamic, in my opinion. When a company essentially promises the market they will more than double their revenue, that expectation gets baked into the current stock price immediately. Doesn't that mean perfection is already the baseline?
It absolutely does. It creates a classic beat or bust scenario. If they can somehow exceed that 108%, or if they offer forward guidance suggesting the third quarter will be even stronger, we could see a massive momentum rally.
It forces the sideline money back in.
Right. It forces institutional money off the sidelines. But you're entirely correct if they come in at, say, 95% growth.
Which would normally be amazing.
Which in any normal sector would be legendary. But this specific stock will be punished severely for missing that hypergrowth trajectory. The margin for error is essentially zero.
What about the physical catalysts? Earnings give us the financial snapshot, but what about the actual concrete being poured?
We really need to watch the deployment of that West Texas Helios facility very closely.
What does that do?
Updates on the power capacity actually coming online are expected in the late third quarter or early fourth quarter. A successful on-time rollout proves to the credit markets that they can actually execute on these multi-billion-dollar debt packages.
And if they delay?
If there are supply chain delays or cooling issues, the market will panic about those massive debt payments.
Makes sense.
Additionally, you always have to monitor the macro tailwinds. Anytime a major player like Microsoft or Meta announces an increase in their capital expenditure budgets for AI, it acts as a direct, sympathetic catalyst for CoreWeave. It just reinforces the thesis that the spending cycle is accelerating.
Okay, so we have the fundamental story and the upcoming catalysts. Let's look at the literal tape. Let's pivot to the technicals and look at the chart structure because, price action rarely lies.
It never does.
Currently, the stock is sitting at $82.64. But what stands out to me is that it's actually 46.1% off its 52-week high.
Which was up around $153. That is a brutal correction from the peak.
It is a massive haircut. The initial post-IPO euphoria clearly just shattered. If we look at the intermediate-term metrics, the 13-week return is sitting at negative 31.90%.
Oof.
Yeah, anyone who bought the hype a few months ago is feeling significant pain right now. However, it seems to have found a definitive floor well above its 52-week low of $63.
That's a good sign.
Right. And despite that brutal 3-month drawdown, the stock is actually up over 11% year-to-date. From a structural standpoint, it looks like it is desperately trying to build a base right here in the 80s.
It's a classic consolidation phase. It washed out the weak hands, the retail investors who just bought the headlines, and now it's trying to establish a level where institutional buyers feel comfortable stepping back in.
But it's not going to be a smooth ride.
No, not at all. If you're watching this base form, you have to account for the extreme volatility. The stock carries a beta of 2.94.
Which means it is practically 3 times as volatile as the S&P 500.
Exactly.
When the market sneezes, this stock catches pneumonia. But when the market runs, this stock acts like a rocket.
That's the perfect way to put it. And we saw a flash of that upward volatility today with the nearly 4% jump, but and this is important, you have to look under the surface of that price movement.
And that is the exact warning sign I want to highlight for you. Today's price jump looks great on a screen, but the volume behind the move is deeply concerning.
Super light.
The trading volume is only 0.83 times the 3-month average. It is actually below average volume.
Yeah, that's a red flag.
If you see a stock pop on good news, like a major buy upgrade from Truist, but the trading volume doesn't surge past the historical average, you have to stop and ask yourself, who is actually buying?
Right.
If institutional money isn't flooding into the name to drive that volume up, it means the price is just drifting higher on light retail trading. And price spikes built on light volume are notoriously fragile. They tend to fade very quickly.
Which makes reading the market sentiment so incredibly tricky right now. Because if you just look at the surface level news flow, the mood is overwhelmingly positive.
The sell-side analysts certainly seem to be in love with it. We've seen a wave of bullish initiations. Baird launched heavily bullish coverage, and of course Truist just slapped that buy-up rate on it.
They love the narrative.
Wall Street is actively trying to build a consensus narrative that this is the premier infrastructure play.
And that narrative is being bolstered by the credit markets, too. That $3.5 billion private debt offering by Galaxy Digital isn't just about cash. It's a massive sentiment driver.
How so?
Well, in institutional circles, when credit markets are willing to lend billions to a single project, it implies a deep structural belief in the company's long-term viability. Speculation is already swirling that this level of backing might foreshadow deeper strategic partnerships, maybe joint ventures down the line.
So the debt guys are essentially co-signing the business model.
Exactly. The smartest debt investors in the room are essentially voting with their wallets that this capacity expansion will print money.
I hear you on the analyst upgrades and the credit market confidence, but we have to address the elephant in the room.
Let's do it.
And for me, this is a massive, blinking red caution light that completely disrupts the bullish narrative. Insider selling.
Yes, it's heavy.
Over the last 90 days, company insiders have net sold over 33.54 million shares on the open market.
That is a staggering amount of equity being unloaded.
33.5 million shares. You can show me all the bullish analyst reports in the world. You can show me the debt financing. But if I am an investor looking to allocate my hard-earned capital, and I see the founders and executives aggressively taking chips off the table, it stops me in my tracks.
I don't blame you.
Why should I be buying if the people running the company are selling by the millions?
It's the most valid concern you can have, but you do have to place it in the context of the corporate life cycle.
Okay, what's the context?
This is a relatively recent IPO. When a company goes public, there are strict lockup periods where early investors and founders cannot sell a single share, usually for about 6 months.
Right.
When that window finally expires, it is entirely normal to see a massive flood of volume. These founders have had all their wealth tied up in this one illiquid asset for years, and they're finally diversifying. It doesn't necessarily mean they believe the core business model is failing.
I understand the mechanics of lockup expirations, I do, but the psychological and mechanical impact on the stock is undeniable. It creates a literal overhang.
Yes, it does.
Sustained selling of that magnitude caps your upside momentum. Every single time the stock tries to rally on good news, there is a wall of insider supply just waiting to hit the bid and suppress the price.
And that naturally transitions us into the pure risk profile, the bear case. Because if you're going to take a position here, you have to understand exactly how this thesis falls apart.
Let's lay it out. We've touched on the leverage, but it really needs to be the absolute focal point of the risk assessment. That $3.5 billion junk bond sale for the Texas facility highlights a business model that requires a terrifying amount of constant capital just to survive.
The nightmare scenario here is a concept known in the infrastructure world as stranded assets.
Unpack that for us. What does a stranded asset look like for a company like this?
Well, CoreWeave is building highly specialized, hyper-dense, liquid-cooled data centers. These are custom-built for the massive, power-hungry AI chips we use right now today. But technology evolves rapidly. What happens if, in 2 years, artificial intelligence model training becomes vastly more efficient? What if the next generation of chips requires a fraction of the compute power and cooling?
Oh, wow.
Suddenly, you have a 260 megawatt facility that is completely over-engineered for the market's needs. And because it's so specialized, you can't just easily convert it back into standard cloud storage for regular tech companies.
Unfuturable.
You're left holding a massive empty building, and you still have to pay the interest on the billions you borrowed to build it.
It is a terrifyingly binary bet.
Yeah.
And you pair that risk with the broader macroeconomic environment. If we see a recession or even just a slowdown in tech revenues, the first thing big companies slash is their experimental capital expenditure budget.
Absolutely.
Because this is a highly leveraged play. Any macro slowdown in the AI sector won't just bruise CoreWeave. It will hit them disproportionately hard compared to a diversified giant like Microsoft or Alphabet that has other revenue streams to fall back on.
They don't have a safety net.
Exactly. Add that leverage to the insider selling overhang we just discussed, and the downside risk is very real. If the macro environment even slightly hesitates, that 46% drawdown from the highs might just be the first leg down.
So with all the fundamental growth, the massive debt, the upcoming earnings, and the insider selling on the table, where do we land?
Well, based on the structural analysis, CoreWeave earns a bullish score of 7 out of 10.
Okay, a 7 out of 10. We're classifying this firmly as a speculative bullish play. It is the absolute definition of a high-risk, high-reward infrastructure bet.
If we break down the time horizons in the short term, this is setting up strictly as a swing trade that is highly leveraged to the upcoming second quarter earnings report.
Heavy emphasis on highly leveraged.
Yeah. The stock is clearly attempting to base in the low 80s, and a massive beat on that 108% growth expectation could violently reverse the recent intermediate downtrend.
And looking long-term, this remains a secular play on a fundamental physical reality. Traditional hyperscalers simply cannot build specialized cooling and power capacity fast enough.
They just can't keep up.
Exactly. CoreWeave is perfectly positioned to capture the overflow of what might be a historic technological spending cycle, driven by those massive targets like OpenAI's $750 billion.
But you have to respect the risks. The debt leverage is extreme, the insider selling is heavy, and any slowdown in the broader artificial intelligence narrative will punish this specific stock severely.
It's not for the faint of heart.
Not at all. This is for investors who can stomach high beta volatility and extreme capital intensity. And as a reminder, this analysis is not financial advice. You must do your own research, look at your own portfolio goals, and understand your personal risk tolerance before making any investment decisions.
Absolutely. And if you want to be able to map out these volatile price zones and base building attempts for yourself, check out VIP Algos through the link below in the description.
It really is a game changer for visualizing the chart.
It is. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and areas to plan your take profits and stop losses. It's designed to make chart reading clearer, but remember, it is only an educational chart analysis tool.
It's educational.
Right. It is not financial advice, it does not place trades for you, and it certainly does not guarantee results. Trading always involves risk, so do your own research and manage your capital wisely. That is an affiliate link, so we may earn a commission at no extra cost to you.
And if this deep look into the infrastructure of AI helped you see the market a little clearer today, please subscribe, like, and comment underneath. We will see you in the next Smart Wealth with Joshua.
See you next time.
But as you watch this AI space evolve over the next year, I want you to leave with this thought. If artificial intelligence models eventually cross a threshold and become incredibly efficient, requiring a fraction of the power and cooling they do today, will these massive, hyper-specialized, multi-billion-dollar data centers become the empty shopping malls of the 2030s?